You've done what you do, which is to say survey the macro landscape. This time, you found some troubling signs. What specifically is of concern?
Well, I think what we're seeing, I'm not sure it's troubling, but there's clearly a disconnect where we've got $10 trillion of negative yielding rates around the world. And at the same time, you've got major deficit increases in most of the developed markets and bigger debt loads in corporations. So that seems somewhat anomalous to have low rates when leverage is going up. And so I think what we're seeing from a lot of investors right now, certainly insurance companies and pensions, is there's a real investment risk today, which is most people didn't expect rates to be as low as they are, and they're trying to find ways to generate income. And that's really been a focus of KKR past couple of years, but we've really stepped on the throttle in terms of, or stepped on the pedal in terms of accelerating our push into some of these income-generating markets.
And by the same token, the forces of demographics on the one hand and technological advancement on the other are keeping a lid on inflation.
Yeah, I mean, we put a piece out today that I think highlights, really on the technology side, a point that I think a lot of investors are missing, which is technology, if you use the U.S. as a proxy, is leading to about a 40 basis point decline in annual inflation. That's
every year.
Every year. That's a major. I mean, think about the announcements we had 2 weeks ago with Walgreens, with generics. They had issues around pricing. We had the same thing where Amazon bought Whole Foods, and 2 weeks ago they announced that they were taking price cuts of 20 to 50%. There's really, I would say, a headwind to inflation coming up. And if you couple that with demographics and then just slower GDP growth in China, I was in China last week, and I've been going there for a long time. I mean, nominal GDP growth in China used to be 20%, and now it's somewhere between 6 and 12. And so it just feels slower. And in that environment, it's very hard for interest rates to break to the upside.
Henry, you call this the uncomfortable truth.
Yeah.
Is that, and this is not as facetious a question as it may sound, is that closer from an investor's standpoint, right? Is that closer to Al Gore's inconvenient truth, right, or Jack Nicholson's you can't handle the truth?
I think it's a little more that you can't handle the truth, which is, to me, your later cycle, this is a time where you want to own yielding assets, but you want to have ones that don't have massive duration risk. And so as a firm, what we've been trying to do for our clients is really find collateral that's linked to nominal GDP. So things around housing, things around aircrafts, locomotives, infrastructure. Infrastructure is a huge business for KKR. Real estate credit, where you have some collateral that if we go into a downturn, you have something to hold on to. But it's also cash flowing, and we've tried to do it using leverage that's not outsized.
And that's because in the interim, inflation is effectively non-existent, and you think rates are going to be lower for longer?
I do. I think if there's a risk, it would be the late 1960s analogy, where ultimately you had very low rates, and then you had some policy mistakes which hurt you in the 70s. I think today what's different is the demographic picture is much different. Savers really are dominating the market, and we don't see the policy mistakes in terms of the central bank. I think clearly the U.S. is leading the charge on running bigger deficits. It's one of the reasons we want to have some inflation protection. But again, we're trying to do that barbell of having inflation protection, but also having some outsized yield for investors.
Give people a sense of what to expect. Where do you think we'll see the bottom on Fed funds? Where do you think we'll see the bottom on the 10-year Treasury?
Look, I mean, to me right now, the market is offsides, which is the equity market. It right now has three quarters of no earnings growth, and it has 10% growth in the fourth quarter, saying things are going to be fine. The bond market saying there's a 70% chance of a rate cut by September. Can't be both of those. So to me, I think there's a better chance that the Fed does not cut. That would be my analysis for this year. But I also think that hockey stick earnings growth in the fourth quarter is probably a little miscalculated.